In 1982, I was 33 years old, and I lost everything. I went on national television. I predicted an economic depression. I was confident. I was certain. I was the smartest guy in the room. I was completely wrong. The market went up, the economy boomed, and I looked like an idiot. My clients left. My reputation was destroyed. I had to borrow $4,000 from my father just to pay my bills. That failure forced me to ask a question. What do billionaires know that I don't? What are they doing that I'm not doing? So I spent the next 5 years studying them. I interviewed 50 billionaires. I watched how they operated. I analyzed every decision they made, and I found 7 principles that every single one of them followed religiously. But here's the strange part. When I'd ask them directly, what's your secret? None of them mentioned these principles. They'd talk about hard work, vision, taking risks, the usual stuff. Only later, when I'd watch them operate, would I see the 7 principles in action. And when I pointed out, they'd say, oh yeah, I do that. Doesn't everyone? No, everyone doesn't. That's why everyone isn't a billionaire. I'm about to give you all 7, not the stories billionaires tell, the actual operating system they run on, the invisible rules that guide every money decision they make. And here's what I need you to understand. If you're not following at least 5 of these right now, you will never build wealth. Not because you're not smart, but because the math doesn't work without these principles. So pay attention, because in the next 20 minutes, I'm going to show you exactly what separates billionaires from everyone else. Let's start with principle number 1. Principle number 1, painful reflection equals progress. In 2008, I watched billionaires lose hundreds of millions of dollars. Some lost billions. I watched hedge fund managers blow up. I watched real estate moguls go bankrupt. I watched tech entrepreneurs see their paper wealth evaporate. And here's what I noticed. There were 2 types of responses. Type 1, blame the economy, blame the government, blame the Federal Reserve, blame fraud, blame bad luck. These people never recovered. They're still bitter today, 15 years later, talking about how the system is rigged. Type 2, reflection. What did I miss? What signals did I ignore? What principle did I violate? What can I learn from this so it never happens again? These people rebuilt, and most of them are wealthier now than they were before the crash. The difference wasn't intelligence. The difference wasn't capital. The difference was their relationship with pain. Most people avoid pain. When something goes wrong, they want to forget about it as fast as possible. Move on. Don't think about it. Bury the failure. Billionaires do the opposite. They dissect pain. They study it. They write about it. They turn it into a system so the pain teaches them something valuable. I learned this from a billionaire named Paul, not his real name. Paul lost $200 million in 2008. His fund dropped 60%. His investors fled. He almost shut down. But Paul did something unusual. He spent 6 months analyzing every mistake he made. He found 12 violations of his own principles. He turned them into 12 new rules. Today, Paul manages $8 billion and is worth over $1 billion. He credits that entire comeback to those 6 months of painful reflection. That's the principle. Pain plus reflection equals progress. Pain alone equals nothing. Reflection alone equals theory. But pain plus reflection, that's the formula for getting rich and staying rich. So here's the question you need to ask yourself. When was the last time you lost money? When was the last time an investment went wrong? When was the last time you made a financial mistake? Did you reflect on it? Did you write it down? Did you analyze what principle you violated? Did you create a new rule to prevent it from happening again? Or did you just move on and hope the next investment works out? Because if you're not reflecting, you're not learning. And if you're not learning, you're repeating the same mistakes forever. Billionaires reflect. That's principle number 1. Principle number 2, never lose money. This sounds stupid. Obviously, you don't want to lose money. Everyone knows that. But here's what billionaires understand that you don't. It's not about avoiding losses. It's about structuring your life so that a single loss can't destroy you. Warren Buffett famously said, rule number one, never lose money. Rule number two, never forget rule number one. People laugh when they hear that. They think it's a joke. It's not. What Warren means is this. If you lose 50% of your money, you need to make 100% just to get back to even. The math of losses is brutal. It's asymmetric. It's unforgiving. So the real principle isn't never have a losing investment. That's impossible. The real principle is never put yourself in a position where one bad decision wipes you out. Let me tell you about David. Real name. David was a billionaire in 2006. He made his money in real estate. He was leveraged. He had borrowed heavily to buy properties, and when the market was going up, leverage was his friend. He was making 50% returns. He felt like a genius. Then 2008 hit. Property values dropped 40%. His lenders called their loans. He couldn't refinance. He was forced to sell at the worst possible time. He lost everything, not just his profits, everything. His entire billion-dollar net worth gone in 18 months. Compare that to Sarah. She also invested in real estate, but she never borrowed more than 30%. She kept 2 years cash. She never made a bet that could destroy her. During the boom, David made 50% returns. Sarah made 15. David called her scared. 2008 hit. David went to zero. Sarah lost 10%, then doubled her net worth buying assets at fire sale prices. Today, David works a regular job. Sarah is worth $3 billion. That's the principle. Never lose money doesn't mean never have a down year. It means never structure your life so that a down year destroys you. Always have a buffer. Always have liquidity. Always have optionality. Always have a margin of safety. Because the people who survive the crashes are the people who win, not the people who make the most during the booms. So here's the hard question. Are you positioned to survive a crash right now? If the market drops 50% tomorrow, are you okay? If you lose your job, can you survive for 2 years? If your biggest investment goes to zero, does your life continue? If the answer is no, you're violating principle number 2, and you're one bad year away from starting over. Principle number 3, compound interest is the only magic that exists. Albert Einstein allegedly called compound interest the 8th wonder of the world. He said those who understand it earn it, those who don't pay it. I don't know if Einstein actually said that, but it's true. Every billionaire I know understands compound interest at a cellular level. They feel it, they live it, they structure every decision around it. Most people understand compound interest intellectually. They've seen the charts, they know that $10,000 invested at 10% for 30 years becomes $174,000. They get it, but they don't feel it, so they don't act on it. Billionaires act on it. Let me show you what I mean. I know a billionaire named Richard. He's 78 years old, worth about $4 billion, and he still lives in the same house he bought in 1983. Drives a 15-year-old car, wears the same watch he's worn for 30 years. People think he's cheap. He's not cheap. He understands compound interest. Richard told me once, every dollar I spend today is a dollar I can't invest. And every dollar I can't invest is $7 I won't have in 10 years, and $70 I won't have in 20 years. So when I'm about to buy something, I ask myself, is this worth 70 future dollars? Most of the time, the answer is no. A fancy car isn't worth 70 times the price. A bigger house isn't worth 70 times the cost. An expensive watch isn't worth 70 times what I'd pay for a normal watch. So he doesn't buy them, not because he can't afford them, because the compound interest he'd give up is worth more than the thing. That's the mindset. That's the feeling. That's the principle in action. Now, here's where most people screw this up. They think compound interest only matters for investing. Wrong. Compound interest applies to everything. Your skills compound. If you spend 1 hour a day learning a high-value skill, in 10 years you're an expert worth 10 times what you are today. Your relationships compound. If you help one person a week, in 10 years you have a network of 500 people who trust you and want to help you back. Your reputation compounds. Every time you deliver on a promise, your reputation gets slightly better. Do that for 20 years and you're known as the most reliable person in your industry. Billionaires understand this. They don't just compound money, they compound everything. Skills, relationships, reputation, health, knowledge, everything. And here's the brutal truth. As you're not compounding, you're falling behind because inflation is negative compounding. Lifestyle inflation is negative compounding. Bad habits are negative compounding. So the question isn't whether you're compounding. The question is, what are you compounding? Are you compounding assets or are you compounding liabilities? Most people compound liabilities. They buy stuff on credit, they take on debt, they develop expensive habits, and they wonder why they're not getting ahead. Billionaires compound assets. They invest every dollar. They build every skill. They nurture every relationship. And 20 years later, they're billionaires. That's principle number 3. Principle number 4. This is the big one. What separates millionaires from billionaires? Asymmetric risk is the only game worth playing. Asymmetric risk means you risk $1 to make $10. Or you risk 1 year of work to build a business worth 10 million. Or you risk a small amount of reputation to gain massive credibility. The upside is vastly bigger than the downside. That's asymmetry. Most people play symmetric games. They risk $1 to make $1. They risk their career for a 10% raise. They risk their savings for a 10% return. Billionaires don't do that. They only play when the odds are massively in their favor. I learned this from a tech billionaire named James. James started 7 companies. 4 of them failed completely. 0 revenue, total losses. 2 of them were modest successes. He sold them for a few million each. One of them became a $10 billion company. James spent the same amount of time on all 7 companies, roughly 2 years each. Same effort, same energy, same risk. But the returns were asymmetric. 4 failures, 2 small wins, 1 massive win. And that 1 massive win made him a billionaire. That's the game. You don't need every investment to work. You don't need every bet to pay off. You need 1 asymmetric win that's so big it covers all the losses and makes you wealthy. But here's the key. You can't get asymmetric wins if you're not taking asymmetric risks. And most people won't take asymmetric risks because they're scared of the downside. Let me give you an example. Starting a business is asymmetric risk. You risk 2 years of your life and maybe $50,000 in savings. If it fails, you lose 2 years and $50,000. That's the downside. If it succeeds, you could build a $10 million company or a $100 million company or a $1 billion company. The upside is unlimited. The downside is capped. That's asymmetry. But most people won't start a business. Why? Because they're scared of losing 2 years and $50,000. They can't see past the downside. Meanwhile, those same people will work a job for 40 years. They'll trade 40 years of their life for a salary that barely keeps up with inflation. They'll retire at 65 with maybe $500,000 saved. That's the metric risk. You trade time for money, 1 to 1. There's no upside. You can't get rich working a job unless you're a CEO. And even then, you're trading time for money, just at a higher rate. Billionaires avoid symmetric risk. They only play asymmetric games. They start businesses. They invest in early-stage companies. They buy real estate in emerging markets. They take calculated risks where the downside is small and the upside is enormous. And yes, most of those bets fail. But it only takes 1 massive win to change your life forever. So, here's the question. What asymmetric risks are you taking right now? What are you doing where the upside is 10 times or 100 times bigger than the downside? If the answer is nothing, you're playing the wrong game. You're trading time for money. You're stuck in symmetric risk, and you'll never be wealthy. Principle number 5. Debt is either rocket fuel or poison. There's no in between. This is the principle that confuses most people because billionaires use debt, a lot of it, but they use it completely differently than you do. Most people use debt to buy liabilities, cars, furniture, vacations, things that lose value the moment you buy them. That's poison. That's debt working against you. Billionaires use debt to buy assets, real estate, businesses, equipment, things that generate cash flow and appreciate in value. That's rocket fuel. That's debt working for you. Two people, same $100,000, same amount of debt. Person A bought a house to live in. 20 years later, $700,000 net worth, zero income. Person B bought 5 rental properties. 20 years later, $900,000 net worth, plus $60,000 a year passive income. Same debt, different outcome. Person A bought a liability. Person B bought assets. That's the principle. Debt isn't good or bad. It's a tool, like a knife. You can use a knife to cut vegetables, or you can use it to hurt yourself. The knife doesn't care. Billionaires use debt like rocket fuel. They borrow money at low interest rates to buy assets that generate higher returns. They lever up their winners. They create massive wealth with other people's money. But they never borrow to buy things that lose value. They never use debt for consumption. They never put themselves in a position where debt can destroy them. That's the difference. So here's the question. Do you have debt right now? What did you use it for? Did you use it to buy a car? That's poison. Did you use it to buy a rental property? That's rocket fuel. Did you use it to buy furniture? Poison. Did you use it to start a business? Rocket fuel. If most of your debt is financing liabilities, you're using poison. Stop. Pay it off. Never do it again. If you have no debt at all, you might be leaving money on the table. Billionaires aren't afraid of debt. They just respect it. They use it strategically. They use it to amplify returns on assets. Learn the difference. Because debt used correctly is the fastest path to wealth. Debt used incorrectly is the fastest path to bankruptcy. Principle number 6, your network is your net worth. This is the principle that sounds like a cliche. Everyone's heard it. Everyone nods along. Nobody actually follows it. Billionaires follow it obsessively. I've watched billionaires spend 3 hours at a dinner with someone they just met. Not because they want something from that person, but because that person is interesting, because that person knows things they don't, because that person might introduce them to someone valuable 5 years from now. I've watched billionaires fly across the country just to attend a 2-hour event because the right people will be there. I've watched them invest in businesses that don't make financial sense just because they want to build a relationship with the founder. They understand something most people don't. Every opportunity that ever mattered came through a person. Every big deal, every major investment, every career breakthrough. All of it came from knowing the right person at the right time. You don't find opportunities by searching the internet. You find opportunities because someone you trust calls you and says, "Hey, I've got something you should look at." Let me tell you about how I learned this. In 1994, I was invited to a small dinner in New York. 8 people, all of them successful. I almost didn't go. I was busy. I had work to do. But I went, and I sat next to a guy named Michael. We talked for 2 hours. We hit it off. We stayed in touch. 3 years later, Michael called me. He said, "Ray, I'm working with a sovereign wealth fund. They need someone to manage part of their portfolio. I thought of you." That relationship turned into a $1 billion account for Bridgewater, which led to other sovereign wealth funds, which led to us becoming the largest hedge fund in the world. All because I went to a dinner I almost skipped. That's the principle. Your network is your net worth, not because you use people, but because relationships create opportunities that don't exist otherwise. And here's what most people get wrong. They try to network when they need something. They go to events looking for investors. They reach out to people asking for favors. They treat networking like a transaction. Billionaires network when they don't need anything. They build relationships for the sake of relationships. They help people without expecting anything in return. They stay in touch for years, decades even. And then when an opportunity appears, they have someone to call. They have someone who trusts them. They have access that money can't buy. So here's the question. How many people could you call right now who would take your call immediately? How many people trust you enough to invest in your idea without a pitch deck? How many people would introduce you to their network if you asked? If the number is less than 10, you don't have a network. You have a contact list. There's a difference. Start building real relationships today. Not because you need something, but because billionaires understand that the most valuable asset isn't money, it's trust. And trust takes years to build. Principle number 7, the game is internal, not external. This is the principle that ties everything together. And it's the one most people never figure out. Billionaires don't make decisions based on what other people think. They don't buy houses to impress neighbors. They don't buy cars to show status. They don't chase trends to fit in. They make decisions based on principles, based on systems, based on what actually works, not what looks good. I've sat in rooms with billionaires wearing $20 watches, driving 10-year-old cars, living in modest homes. And I've sat in rooms with broke people wearing Rolexes, driving leased BMWs, living in houses they can't afford. The difference isn't the money. The difference is the game they're playing. Broke people play the external game. They spend money to look rich. Billionaires play the internal game. They invest money to become rich. The people trying to look successful never get there. The people building real wealth don't care what you think. And here's the paradox. The people playing the external game never get rich because they're spending all their money on looking rich. The people playing the internal game get rich because they're investing all their money in assets. Let me be very clear about something. If you're making financial decisions based on what other people think, you will never be wealthy. Never. Because other people want you to spend money. Other people want you to buy stuff. Other people want you to stay broke so they feel better about being broke. Billionaires ignore all of that. They have principles, they have systems, and they follow them regardless of what anyone else is doing. That's the 7th principle. The game is internal, not external. So there you have it. 7 principles billionaires follow, but never discuss publicly. Pain plus reflection equals progress. Never lose money. Compound interest is magic. Asymmetric risk is the only game worth playing. Debt is rocket fuel or poison. Your network is your net worth. The game is internal. These aren't secrets. These aren't complicated. These aren't hard to understand. But they're hard to follow, because following them requires discipline. It requires delayed gratification. It requires thinking long-term in a world that rewards short-term thinking. Here's what's about to happen. 99% of you will close this video, say interesting, and change nothing. In 10 years, you'll be watching another video just like this one, still broke, still hoping. 1% will pick one principle today, not tomorrow, today, and commit 90 days. That 1% will be richer in 2 years than the other 99% will be in 20. Which group are you? The 99 or the 1? I already know the answer. The 99 don't make it to the end of videos. If you're still watching, you're probably the 1%. So prove it. Pick a principle. Execute today. I'll see you in the next video.